What is up? Thursday, March 27th. Zach Howard here. Morning market update. Tariff day, Liberation Day, fast approaching. April 2nd. We have an announcement last night that the auto sector is going to be hit probably the most significantly from any specific industry. Mexico, Japan, South Korea, Canada. These numbers are actually lower, published by Bloomberg, than what some AI services are telling me. But overall, amounting to somewhere between 200 to 400 basis points of each country's GDP. So we're going to have effects on global economics and global growth. Absolutely. Canada's sector specifically has a lot of spin-off industry there. Handicapping all these tariffs here is very difficult, headline to headline, but looking through the lens of what the market signals are when it comes to yields and currencies, commodities, more of a telltale sign. What are investors worried about? Well, everyone's focused on headlines and tariffs, obviously, but like what's out there we don't know about that's potential risk to the geopolitical and economic backdrop. AI bubble is pretty low if you look at this survey results, but it's significant amount of inflated fiat money still in these bubbles of AI companies, particularly the biggest in human history, NVIDIA, out yesterday down 6% with 292 million shares traded. When you had that kind of volatility and that kind of sell-off, and then you had the volume on top of it, that's a signal you got to pay attention to when the biggest fiat market cap in history starts failing like that. On to forward-looking macro data at the U.S. Stagflation signs continue as these important components into Q1 GDP are saying the growth is slowing. Durable good orders continue to fall. Mortgage applications, rate change improvement still negative. Refinancing still falling. So all that to me is a slowdown, U.S. economy. However, looking through the yield curve, which is the signal, not the noise, don't only see a recession immediately on the headlines. We have a positive sloping yield curve, 36 basis points here between those 10s and 2s here today. Even those 10-year 3-month is a positive here. We had previously been inverted. So steepening yield curve is a sign not so much of a slowing recession anytime soon in the U.S. Volatility come right out of that. U.S. Treasury yield, as you look through the MOVE index here, 2 weeks ago was at 114 and closed yesterday at 91. So that's saying we're probably easing up here on the volatility when it comes to treasuries. And my favorite topic, gold. I put up the chart yesterday about how the inflows into the U.S. from London and that physical bars. But where's it going? JP Morgan. Anyone checked out my gold presentation, 20-minute long, a month ago? I talked about the GLD ETF, which JP Morgan is a big custodian. Are they kind of bringing the gold home because they're going to need it? We'll see. Keeping an eye on gold as it approaches 3,100 here today. Amazing run, and it keeps going. And last but not least, keep your head on a swivel out there. It is not over by any means when it comes to risk off for this week and this quarter. Have a good one.